Assalamualaikum and hi. I am Nur Hashimah binti Hasbur Rashid.
And I am Tengku Nur Syahrinisa binti Tuku Anwar. And we would like to present you about Chapter 2,
which is Financial Statement Analysis. Financial statement is a medium by which a company discloses information concerning its financial performance. There are three types of financial statements, which is income statements, balance sheets, and the last one is statement of cash flow. There are three components of balance sheet, which is asset, liabilities, and equity. Asset is a resources that business own. For example, cash, inventories, and machinery. The formula used for finding asset is liabilities plus shareholder equity. Second, liabilities. Liabilities is an obligation which must be paid back. Third, equity. Equity means value of money that owner has contributed.
In this video, we're going to go over a balance sheet example and explain the different parts of the balance sheet. This is another video from accounting101.org. You can visit our site for more accounting videos, tutorials, and explanations like this at accounting101.org. So, the balance sheet. So we're looking at the balance sheet from Scammer Corporation, and at the top you see that it says Scammer Corporation balance sheet December 31st, 2011. So we'll start our explanation right there. Notice that it just says December 31st, 2011. It doesn't say for the period ending December 31st, 2011. And that's because the balance sheet is basically a snapshot in time. Really, you could make a balance sheet every single day of the year, and what it does is just shows you at that point in time what the assets of the company are, what the liabilities are, and what the stockholders' equity are. And it just gives you basically a picture of how the company's doing financially, what they own, what they owe, and who owns what, basically. Now, the first things that you should notice is that here on the left side of the balance sheet we have the assets, and on the right side we have the liabilities, and we have stockholders' equity. Those are the three main parts of any balance sheet, and the accounting equation is assets equals liabilities plus owner's equity or stockholders' equity. So the balance sheet is always basically divided right in half, and on the left side you'll have the assets, and on the right side you'll have both the liabilities and the stockholders' equity. So to kind of understand why that is, the assets is what the company owns. It's stuff like their cash, the accounts receivable, inventory, prepaid insurance, land, buildings, equipment. It's their resources, things that they have to use that will bring some sort of gain or profit or benefit, economic benefit, at some time in the future. That's what an asset is. A liability, well, really the right side of the balance sheet here is basically explaining how the assets were paid for. So the liabilities, account for a certain portion of the assets, and the stockholders' equity does the same thing. So if the company issued a bunch of stock right here to pay for, their inventory and their prepaid insurance and a piece of land, then that's what this number right here is representing, that the company issued stock, to pay for those portions of the assets, and so that's accounted for in the stockholders' equity. So let's say on the other hand that this company, Scammer Corporation, bought a computer so that they could scam people better, and that equipment that they purchased, they bought on account. So it would be accounted for over here in accounts payable. So the 4,000, 2,000, or I guess 2,100 of that is what they owe for purchasing this equipment that shows up in their investments, or I'm sorry, in their assets. So those are the two ways that the liabilities and the stockholders' equity account for what's in the assets portion of the balance sheet. Now, another thing to understand is that let's start with the assets. The assets are divided up into two sections. You have current assets, which are right here, and then you have long-term assets or fixed assets, which are usually right here, and I guess right here as well. Anything that's not a current asset is a long-term asset. So current assets are resources that are going to be used up within a year. So cash, accounts receivable, inventory, prepaid insurance, those are all going to be used up, or it's assumed that they're going to be used up within a year. Then you have property, plant, and equipment, intangible assets such as goodwill or patents. Those may or may not be amortized, but usually those are classified as long-term assets because the amortization, if they are amortized, will take longer than a year. So basically, the two sections are current assets, anything that will be used up within a year, and then anything that will be kept around or will be able to be used for longer than a year is a long-term asset. And so the same thing applies over here. You'll see that this says current liabilities. You have these things, which are accounts payable, wages payable, interest payable, taxes payable. These are your current liabilities, or obligations that need to be satisfied within a year. Then you have long-term liabilities. These are the liabilities that that don't need to be satisfied within a year, that can be put off longer, basically. And then, you add those two together, you have total liabilities. Now down in the stockholders' equity, usually it's the same type of accounts that you'll see over and over again. Whether it's called common stock, capital stock, there's preferred stock. We won't go into those different meanings here. There's retained earnings, and then you just have total stockholders' equity. So the total liabilities plus the total stockholders' equity will equal what the total assets equal. So the two sides of the balance sheet will always balance, as long as the financials have been done correctly. And that is a basic explanation of how the balance sheet works.
Income statement used to measure a company performance. There are three components of income statement, which is revenues, expenses, and profit. Revenues or sales is continually increase year in and year out. Expenses or COGS, also known as cost of goods sold, is a selling, general, and administrative expenses. For profit, the formula to find profit is revenue minus by expenses.
What is an income statement? Presented by WallStreetSurvivor.com. An income statement shows the financial performance of a company for a given time period. It shows a company's revenue and costs and is therefore a pretty good indication of the strength of the company. Income statements are also called profit and loss or P&L statements or revenue and expense statements. Income statements are prepared as a part of a company's financials. All public companies are required to submit them quarterly, regulated by the SEC. So let's look at a simple income statement in practice. Here's Mary. Mary owns her own successful flower shop, Petals, and has begun filing her income statements for the quarter. Last quarter, Mary sold $500,000 worth of flowers. This is her top line revenue. Revenue is also sometimes called sales. Next, Mary needs to add up all the costs directly associated with cultivating her flowers. These costs include things like seeds, earth, fertilizer, and electricity. These are added together and are collectively known as costs of goods sold, or COGS. Revenue minus COGS is known as gross income. Think of this as money made from both growing and selling flowers. After that, Mary adds up her non-direct costs. These are costs she incurs that aren't related to sales. Petal's costs included marketing, rent, and salaries to her 2 store managers. These costs are known as selling, general, and administrative costs, or SG&As, and are often thought of as the company's overhead. Gross income minus SG&As is referred to as operating income, or income earned from a company's operations. Lastly, Mary subtracts taxes from her operating income to get her net income. Mary now has a good understanding of the profit generated from petals. Usually, income statements are a little more complex to put together and are handled by professional accountants, controllers, or CFOs, and follow the general accepted accounting principles. To learn more about income statements and other topics, head over to wallstreetsurvivor.com.
The statement of cash flows is according to 3 core activities. First, cash is raised from the capital suppliers, which is cash flow from financing. Second, cash is used to buy assets, which is cash flow from investing. And third, cash is used to create a profit, which is cash flow from operations. There are 2 types of liabilities: current liabilities and non-current liabilities. Current liabilities is a company's debts that are due within 1 year. Current liabilities appear on the company's balance sheet and include short-term debts, accounts payable, accrued liabilities, and other debts. Non-current liabilities. Non-current liabilities is a long-term financial obligations listed on a company's balance sheet that are not due within the present accounting year. The 2 important equity items are paid-in capital and retained earnings. Paid-in capital is the amount of money shareholders paid for their shares. It represents how much money the firm received when the share was sold. Retained earnings is the money that company choose to invest or reinvest in business rather than pay to shareholders.
Do you have a savings account? I sure hope so. It's good money management practice. Well, corporations have savings accounts too, only it is called retained earnings. Let's analyze these 2 words: retained plus earnings. Retained means to keep. Corporations retain their earnings from year to year to be used for different purposes. What is retained earnings used for? 1. To pay out dividends. 2. Reinvest earnings into other business ventures. 3. Finance other areas of their operations. Earnings is the amount of money earned through the regular course of business after all expenses are deducted. Where is retained earnings reported? Retained earnings is reported in the stockholders' equity section on the balance sheet. So, how do we calculate retained earnings? Here is the equation. Beginning retained earnings plus net income minus dividends equals ending retained earnings. The ending retained earnings is the value that is reported on the balance sheet. Now, let's review. What is retained earnings? It is the amount of income earned through regular course of business that is retained from year to year. Here is the equation revisited. Beginning retained earnings plus net income minus dividends equals ending retained earnings. For more free videos, online courses, and accounting training, visit accountinguniv.com. And remember to subscribe and like. More videos coming your way soon.
That's all from us. Thank you for watching.
I hope you guys like our video and understand it more. Thank you.
Lisa.
Shima.